Hello everyone, today with MarketXLS we're going to talk about the call ratio spread option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. It makes it easier for you to turn your Excel skills and market knowledge into profit. In this video we'll be discussing what a call ratio spread strategy is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A call ratio spread is best implemented when you expect the underlying security to experience little volatility in the near term. A call ratio spread strategy is a limited profit but an unlimited risk strategy. It is a neutral strategy that involves buying a number of call options and selling more call options of the same underlying stock and expiration date at a different strike price. So what we do in this strategy is that we go long on one in the money call option and go short on two out of the money call options of the same underlying security and expiration date. MarketXLS offers a template for this strategy. Here's an introduction page and here's an active template. The yellow cells have to be inputted by the user. So the stock ticker, expiry date, in the money and out of the money strike prices for the call. Some upcoming expiry dates are available for reference on this side. For the purpose of this video, we'll be using Microsoft. Expiry date as 11 June. In the money and out of the money strike prices are $240 and $260. We've bought one in the money $240 call option contract and sold two out of the money $260 call option contracts of Microsoft. In this case, we've built the net debit strategy and paid $969 to enter into the trade, and this is reflected in the net cash flow section. MarketXLS has many templates just like the call ratio spread one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. Maximum gain for the call ratio spread is limited and is made when the underlying stock price at expiration is at the strike price of the option sold. At this price, both the written calls expire worthless while the long call expires in the money as shown by the green box. Maximum loss is unlimited and occurs when the stock price makes a strong move to the upside beyond the upper break-even point, and this is shown by the red box. Any risk to the downside for the call ratio spread is limited to the debit taken to put on the spread. There may even be a profit if a credit is received when putting on the spread. There are two break-even points for the call ratio spread position, the upper and the lower. The upper break-even point is equal to the strike price of short calls plus the points of maximum profit divided by the number of uncovered calls. And the lower break-even point is equal to the strike price of the long call plus or minus the net premium paid or received. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.